Welcome. Welcome, everyone. I'm Angelo Robles. Today, from Boardroom to Backbone, mastering high-stake exits and infrastructure, primarily energy, behind AI. Our special guest today is Paul Burgon, managing partner of Exit Ventures here. But how would you recommend that the new blood that may have some capital that wants to put it to work, that wants to invest in private companies for a sense of control, for family engagement, what are some sources that you recommend in any varying sectors that they get out there and they see what's available? Are there databases? Are there AI enhanced databases, trade shows, investment bankers, business brokers? What are some insider secrets that you have?
Yep. So I'll tell you a little bit of history that helps guide kind of the best thinking right now. Is that family offices probably 5, 6, 7 years ago became much more heavily involved in direct private investments. And they said, we've got a family office, we've got a bunch of resources, we can hire consultants, et cetera. Why pay the fees, right? And primarily they were trying to avoid private equity fees and venture capital fees, and said, why pay the fees? Let's just use our resources and do this on our own. That didn't end well for most family offices because the lack of specific sector expertise, the lack of deal-making experience, the lack of familiarity with the terms, as we were just talking about. It is a very deep well of experience that most fund managers have already acquired. And so there were many family offices that felt a little burned, felt like they'd made some bad decisions. And now the pendulum has swung a little bit more towards saying, let's pay the fees, but learn as we go from our fund managers who, generally speaking, are more talented, more experienced in these specific sectors than we are, unless it's the same sector as the family office, right, where there may be some very deep family experience there. So what I've seen is, family offices are saying, let's invest in funds and get our feet wet, get some experience, work in some cases directly with the investors, the fund investors, to understand these sectors better, and then get involved in direct investments through the fund. So SPVs, co-invests. That's a great way for family offices to leverage the expertise and the due diligence of very talented fund managers when they come to them and say, here's a one-off deal. You can invest in the fund or you can invest in SPVs or both, but we're bringing you a deal that we've diligenced, that we're going to invest in the fund, or we have invested in the fund. So we're eating our own cooking. And now we're giving you the opportunity to evaluate this on a case-by-case basis and get involved and learn that way. And so especially for a newer family office, my recommendation is get your feet wet by learning from people who are already heavily investing in certain sectors, whether it's AI, energy, climate, real estate, what have you. Learn with and alongside those managers, especially through SPVs and co-invests. And then with a body of experience and a decade or more of experience and good results, then family offices start, justifiably so, start investing, and these investments often pan out very well. But if they jump in and think, I can do it all myself without that proper level foundation of experience, that's where we were about 5 years ago, and it didn't end well for many. Some fine, but not many family offices.
Now we got a real interview here, Paul, because we may take a little bit of some opposing sides, and that's how my audience, I would like to hope, best learns. By the way, broadly what you said, I don't have a massive amount of disagreement with. But because I like to be contrarian, and I like to think that family offices strive and can be awesome, maybe there is a way they could skip the line a little bit. So I have concerns that the so-called professionals could be bureaucratic and often not that good. If they're too large, they become effectively asset gathering machines that are looking to collect 2 and 20, and they become almost too big, too bureaucratic, especially in certain sectors and venture capital and private equity to even move the needle net of fees. And if you look at some of their return profiles, those that even want to share in more public databases, what their return profiles are, net of fees and the limitations of it, not always quote unquote so attractive. The advantage that I'm going to have as a family is potentially the capability of moving quicker. That's one. I'm going to have patient capital. I'm not looking to have a strategic exit or this or that in 3 years or 5 years. Maybe I want to own it for decades. There are some other advantages that maybe you're leaving out, where if I'm a family that desires control, I want to have control. I want to have the controlling interest, however that's defined to the business. I want my family to learn, meaning my rising generations, how the real world works, how you negotiate, how business owners lie to you, how you need to not only not really trust, but verify, how you negotiate with banks, how you do financing. There's lots of life lessons in that. And you're correct. You're correct. Am I going to have the expertise in those verticals? More likely not. But could I structure, and I don't want to get too deep on holdcos here, but I could bring in the right operator and incentively align them that we're in it together for the growth of what we're building. I may underpay you a little bit from an annual quote unquote compensation, but you're going to be treated, maybe it's phantom equity, but you're going to be treated like an equity holder. And we're going to look at various exit opportunities for you that may be 3 or 5 years down the road. So could I make that point that I was a little long-winded, as I usually am, that there are grains of truth, if not more, to my perspective of jumping in at the advantageous opportunities for a family if they're doing some of the things I'm noting correctly?
Yeah, this is so interesting. We did not coordinate our comments, just for the audience here, Angelo, but I literally made a LinkedIn post on this, I think 7 to 10 days ago, on the precise topic that you mentioned of large funds becoming asset gatherers, and frankly, the blatant conflict of interest that exists when you're making anywhere between $50 to $200 million a year from your 2% fee. What incentive do you have to rock the boat and get the best tier returns for your investors? They're locked into a 10-year fund where the fund manager's making $50 to $200 million, right? Like, don't rock the boat. The statistics show that first and second funds consistently outperform large funds, and I think it's because of the conflict of interest issue that you mentioned and that I just mentioned. My LinkedIn post, end of May, like the third week of May, depending on when you're watching the recording here, third week of May of 2025, talks about the statistics that show that first and second funds get the top performing numbers and performance of the year 73% of the time. So 73% of the best performers are Fund 1 and Fund 2, maybe Fund 3, but I don't think so. I think it's Fund 1 and Fund 2. Those funds get the top slot 73% of the time over a 10-year study.
Well, in some ways, that's concerning. Where's the value and experience?
Well, so you have funds that, so I mean, just a shameless plug, Exit Ventures, my fund, right? I've got 30 years worth of investing experience. I've run a hedge fund before, but this is my first venture capital fund, right? So some people would say, well, you've got fund experience, you've invested $3 billion, you've got the experience to run a fund. And others like, nope, you're a Fund 1. I can't really trust you with the experience that you need in order to run a fund, right? So some people will say that Fund 1s are risky because you don't have any track record. If the fund managers have a very solid track record, but they just happen to be putting together the first fund, then, that seems like a reasonable bet to me. I mean, that's the bet I'm making, and I'm asking other people to make. But the statistics actually show from multiple independent sources that first and second funds outperform the big funds precisely because of the issue that you mentioned. And I think it's because you have, in a smaller fund, you have the hunger, you have the alignment of interests, you have the grit, you have the hours, that are required to launch fund one or fund two, that frankly, when you're making 200 million a year, you don't really worry about as a large fund. So my personal, and again, I am speaking my own book here, so I'll raise my hand and say that, but the statistics show that from a fund management perspective, smaller funds tend to outperform the larger funds. I think it's due to the conflict of interest. Because others are contrary, Angelo, some people would say the larger funds, because they're so big and have such immense resources, that they can anoint market leaders in any particular industry by saying, we're going to anoint this one company the leader, we're going to put in 50 to $100 million, and they're going to obliterate everybody else with our capital. Some people believe that, and so they invest in the very large funds, but the numbers don't support that belief. So whatever you want to believe, there are people on both sides. Intelligent people will disagree on this point, but I say I'm a data-driven person. Let's look at the numbers, and smaller funds typically outperform. We can have a conversation on this, Angelo, all day long. But what I'm saying is I agree with you. And your last point, just really briefly, you said hire somebody. Let's get someone with experience and invest together with aligned interests. I mean, you're basically replicating a pseudo fund, right? And that's a reasonable position to take.
With a big difference that I have patient capital, and I don't want to turn my kitchen into a restaurant and take in others and get additional regulatory scrutiny as well. Now, yes, I would offset the cost of the internal talent by doing that. I may be able to have more capital to put to work. You have to weigh this as a family. My experience, most real single family offices, they're better off probably staying that way and not looking to get too cute, becoming more of a commercial enterprise where there's way more competition, way more scrutiny. And I think just looking at what I've seen, it's just harder. And I know it's something that I don't have an interest in, but that's just me.
Yeah, look, I mean, intelligent people have really strong opinions on all of this. I think you're right. Like you can make an argument to say that let's stay clear of other investor entanglements. Let's hire someone. And if you've got that person or those people that can replicate, pretty much all of the experience factors that you need, the investment side, the industry side, the investment terms, the board seat, and the exit creation, right? If you can effectively replicate all of the resources that you would typically get in a fund, and you can do it on a cost-effective basis that's entirely driven by the family office, it's not a bad gig. I mean, it's not. But that requires probably multiple people who are really talented, where you've got to make the right hires. If you can do that, I mean, more power to you. You've basically created your own fund, and that's powerful.
I mean, kind of. If I have a family office that has a CFO and a COO, part of their responsibilities may be to also onboard, enhance, and improve, and do those services for companies that I may be bringing into my holding company, perhaps as an anchor, offsetting losses. And again, we could get a little complex on some of the tax picture here. I don't want to bog things down. Then bringing in the right operator in that given vertical. And like I said, giving them the opportunity, even if it's phantom, but effectively it's kind of the same thing. Well, maybe not as much from the tax perspective. But again, I don't want to get too bogged down in it. But there are various ways to skin the cat.